Have you ever heard of a bank failing not because it was greedy, but because it was too honest? It sounds impossible, right? In the world of finance, we expect scandals to come from lies, cheating, and reckless gambling. But what if I told you about a bank that was destroyed because it tried to play by the rules in a game where everyone else was cheating? This is the forgotten story of a bank that stood for integrity in an age of corruption and paid the ultimate price. To understand how honesty could become a death sentence, we need to travel back to the 19th century. This was an era of explosive growth. The Industrial Revolution was in full swing. Railways were crisscrossing continents. Factories were churning out goods, and empires were being built on a brand new invention: credit. And with credit came banks, hundreds of them. Some were prudent, some were reckless, and many operated in a gray area in between. Our story begins in Scotland, a place surprisingly known as the birthplace of modern stable banking. By the 1800s, Scottish banks were famous for their caution and innovation. They invented branch banking, issued their own currency, and kept famously detailed records. But the banking world was also fiercely competitive, and in that world, your reputation was everything. Among these institutions was a small but respected bank, the City of Glasgow Bank. Founded in 1839, it was the go-to bank for local merchants, factory owners, and everyday savers. Unlike the high-flying speculative banks in London, the City of Glasgow prided itself on conservative lending and honest accounting. It didn't chase risky overseas investments or cook its books to inflate profits. Simply put, it played fair. And for a good while, this strategy worked. The bank thrived. But the world around it was changing at a dizzying pace. By the 1870s, the British Empire was at the peak of its power, and its financial system was addicted to constant, risky expansion. There were railway booms, speculative bubbles in foreign lands, and a gold rush for investments in places like Australia, South America, and India. The big London banks got phenomenally rich by taking massive risks. This left smaller regional banks like the City of Glasgow in a tough spot. The message from the market was clear: grow or die. The directors of the City of Glasgow Bank faced an impossible choice. Should they stick to their old cautious principles that had served them so well, or should they join the mad dash for profit that was sweeping the nation? They made a fateful decision. They tried to do both. And then, in 1878, after decades of quiet, steady success, the City of Glasgow Bank suddenly collapsed. The news sent shockwaves across Britain. It was the largest banking failure in Scottish history and one of the most stunning financial scandals of the entire century. People were horrified. How could this stable, trusted institution just disappear overnight? When investigators pried open the bank's ledgers, they uncovered a nightmare. The bank had secretly funneled enormous loans to failing companies. It had systematically falsified its balance sheets to hide the losses. It had even paid out dividends to shareholders that it couldn't actually afford, all while projecting an image of perfect financial health. In other words, the bank that prided itself on honesty was built on a mountain of lies. But wait, that's not the whole story, because beneath the layers of fraud lies a much deeper, more tragic truth. The collapse of the City of Glasgow Bank didn't start with a lie. It started with honesty. Here's what really happened. In the 1870s, the global economy plunged into a severe downturn known as the Long Depression. It was triggered by overbuilding railways, plummeting prices for goods, and a collapse in international trade. The City of Glasgow Bank, with its conservative approach, initially weathered the storm better than most, but there was a problem. While they were playing it safe, their competitors were still reporting huge profits from speculation and risky loans. Suddenly, the City of Glasgow's small, steady profits didn't look so good anymore. They looked weak. Anxious investors started pulling their money out. Customers began drifting away to other banks that seemed more profitable and successful. The directors, ordinary decent men, found themselves under immense pressure. To save the bank, to protect its reputation and its depositors, they started to gently massage the numbers. At first, it was a small adjustment. They just postponed acknowledging a few losses, telling themselves the market would bounce back soon. It was a temporary measure. Then, as things got worse, they started hiding bad loans off the books. Before long, they were printing entirely false reports to maintain public confidence. They weren't trying to get rich. They were trying to survive. They convinced themselves they were doing the right thing, protecting the bank. But in reality, they were building a financial time bomb. By 1878, the web of lies had grown so vast and tangled that it could no longer hold. The truth finally exploded into public view, and the fallout was catastrophic. Thousands of depositors, people who had trusted the bank with their life savings, were completely wiped out. The shareholders, who, under Scottish law, were personally liable for all the bank's debts, lost everything. We're talking about middle-class families, doctors, widows, and clergymen who were ruined overnight. The directors were arrested, put on trial for fraud, and convicted. 5 of them were sent to prison, their reputations destroyed. But what history often forgets is that their fatal journey began from a place of integrity. The City of Glasgow Bank failed ultimately because it tried to compete in a dishonest system and found that it couldn't survive without breaking its own moral code. This reveals a dark paradox at the heart of finance. Integrity is essential, but it can also be incredibly dangerous in a world driven by both trust and greed. The bank could have chosen to remain small, stable, and honest. But in the hyper-competitive Victorian era, the pressure from shareholders in the market to expand, to impress, to grow at any cost was simply overwhelming. And that story is far from over. Fast forward to our own time. Think about the 2008 financial crisis. Global banks collapsed under the weight of their own false promises. Subprime mortgages disguised as safe investments, complex derivatives nobody understood, and toxic loans hidden from view. Just like in 1878, the system rewarded deception and punished transparency. Whistleblowers who tried to warn people were silenced. Auditors and regulators looked the other way. And the honest institutions, the ones that refused to join the speculative party, were often pushed aside or swallowed up by the giants who did. The modern financial system still often favors short-term risk over long-term responsibility, flashy appearances over hard truth. The collapse of the City of Glasgow Bank was an early warning signal of a systemic disease, a warning that we have largely ignored for over a century. But the story doesn't have to end in failure. Sometimes it's the collapse itself that forces a moment of clarity. After the City of Glasgow Bank imploded in 1878, British banking laws were radically overhauled. Auditing standards were made stricter. Accountability became a serious concept. The idea that directors should actually go to jail for fraud became enshrined in modern law. In a way, the death of one bank that tried to be honest forced the entire industry to become a little more honest itself. And we see this pattern repeat. Every major financial crash seems to follow the same moral cycle. First, a period of excess and greed, followed by widespread deception to keep the party going. Then comes the inevitable collapse, and finally, a period of regret and reform. But the underlying incentives rarely change. As long as the system rewards short-term gains more than long-term integrity, being honest will always be the most difficult business model in finance. So what does it mean to be too honest in finance today? It means being the one who refuses to hide losses when everyone else is. It means saying no to risky profits that only look good on paper. It means having the courage to warn your clients about dangers the rest of the market is ignoring. In an industry often built on illusion, that can make you an outcast. But it's also the only thing that ensures the system's long-term survival. Because every boom, every speculative mania, every bubble in history eventually ends the exact same way, when honesty finally makes a comeback and the truth gets priced back in. The story of the City of Glasgow Bank isn't just a dusty tale from the Victorian era. It's a mirror held up to our own financial world. It's a powerful reminder that while honesty can be costly in the short run, it's the only foundation that truly endures. Because at its core, money is just a form of trust. And without truth, trust dies. And when trust dies, the bank fails. Not because it was too honest, but because the world around it wasn't honest enough to let it live. Thank you so much for watching. If you found this story as fascinating as I did, please hit that like button and subscribe for more deep dives into the hidden corners of history. See you in the next video.